Hi, I'm Wayne Blanchard. I'm a certified financial planner and a member of the Garrett Planning Network. Our question today deals with how do you value tangible assets, tangible asset valuation methods. Well, let's first talk about what are tangible assets. Tangible assets are generally thought of as those assets that are only auction price. Think about gold, diamonds, some of those kind of things that you generally they're traded, but they don't really have any, they don't pay any dividends, they don't, can't analyze them like a regular company. So how do you figure out what something like gold, we use gold as an example, how do you figure out what gold is actually worth? Now think about that. Now, because the value of gold basically is determined by the auction value at any particular time. Now, let's think about how this complicates your investing in gold. Now, if you're going to take actual custody of the gold, mainly there are a couple of ways you can hold gold. You can hold gold as bullion, just big chunks of gold, normally in 1 ounce or 5 ounce type bars, or you can buy gold coins. Now, between these two, there's quite a little difference in terms of what can happen in determining the value. If you take just the bullion, and as soon as you take that gold out of the system, now you have those gold bars, and everybody wants to know, well, how does anybody know that your gold bars really have gold in them? Because over the years, there have been people that would, drill holes in there, take out gold in the center and put in some other metal to make sure that it had its proper weight, and it got traded, and nobody knew until somebody, cut one open and found out, hey, they aren't really all gold. So what has to happen if you take gold out of the system, basically it has to be reassayed. That means they have to find out how pure it is and all that type of thing once you have held it, in order to put it back into the system to sell again. Now, again, or really, once they determine that the value, that the gold is really gold, then they can sell it at whatever the market price is. But whatever the market price is, remember, is just an auction value. It has nothing to do with any kind of intrinsic value of gold. While gold may become something that would be an inflation hedge, but how do you, in essence, buy something with gold if there is no market out there setting the value of gold? How do you say, hey, how can I trade my gold for some flour? Because if we have really tough times, you want to buy food with it, how do you know how much the gold is really going to be worth? So you have to consider that, and you have to consider, even if you're taking gold not because the end of the world is coming, but how do you handle it once you want to get rid of the gold, and you got to think about the additional costs of having it tested to make sure that it is pure. Now, gold coins are a little bit different because they have what is called numismatic value. Now, that means the value of the artist's work and the way that the engraving is, and the way the coin looks, and how circulated it is. A lot of the gold coins are encased in plastic, and they are made in such a way that you can't get to them. And as long as that plastic stays intact, and they're rated by one of the particular rating agencies that are accepted, you should be able to trade those fairly easily, a little bit more easily, say, than gold bullion. But either way, you've got a fairly illiquid investment when you get into things like gold coins or gold bullion. So you need to understand how those things can get valued if you're going to invest in things like gold, diamonds, other precious metals. Be careful. They might be able to help you out, but you need to know what the ins and outs are before you invest.